If the tax exemption were to disappear, over 10 years, local governments would pay out approximately $824 billion in additional interest payments. And we know city budgets are strapped. So where is all that money going to come from? Potentially where it's going to come from is that some projects, in certain cases, many projects are just going to get postponed or canceled. They're just not going to get done. And of course, when that happens, infrastructure condition continues to deteriorate. Needed improvements are not made. Projects are going to cost more. And because of that, you're going to see fewer projects.
Hello and welcome to the Pumps and Systems podcast. I am your host, Tom Baer, a managing editor at Pumps and Systems magazine. Today we're going to be speaking with Tom Decker from Thomas E. Decker Consulting. He's going to be telling us all about funding options for water and wastewater infrastructure projects and how future projects might be impacted by legislation, immigration policies, tariffs, and more. So without any further ado, let's get into the episode. Welcome to the Pumps and Systems podcast. We really appreciate you being here. So how are you doing today?
Thank you, Tom. It's a pleasure to be here with you, and we're doing fine on this end.
Glad to hear it. Okay. So today we're going to be talking about different funding options for water and wastewater infrastructure projects and some related topics. But before we get into that, would you mind introducing yourself? So tell us a little about who you are, what you do, anything you would like our listeners and viewers to know.
Well, I am Tom Decker. I have spent now coming up on about 50 years in the water wastewater field. I worked for a number of the large engineering construction companies over my career. Retired several years ago formally, but now really working with my own consulting firm, and we do strategy, marketing, business management for associations, corporations, and utilities, all in the water wastewater space.
All right, great. Let's move in to our main topic then. So there is a lot of uncertainty going on in the industry right now. So when it comes to funding infrastructure and other projects in water and wastewater, what are the current or ongoing options?
Fortunately, in our business, there are several, and I'll give you a quick overview of each of them. First and the most obvious is pay as you go. Use your own funds, use the own revenue that you generate from your water and sewer bills, and pay for it yourself. We are in really a period of unprecedented increases in rates, particularly over the last 10 to 12 years. In the last 5 years, as an example, water and wastewater rates rose 24% for the 50 largest utilities in the U.S. And frankly, we see this trend continuing. The pay-as-you-go is certainly the first option. The second option is federal funding, federal support, and there are really three main sources of that. First are the state revolving funds, and those were put in place on the wastewater side in 1987 and on the drinking water side in 1996. To date, over $163 billion have gone into the wastewater state revolving funds, and over $53 billion have gone into the drinking water funds. It's a very straightforward, basic process. There's an annual federal appropriation to states for each of these two revolving funds. The states then select the projects that they want to prioritize and the funding amount. The states will chip in an additional 20% on that funding, and they release the funding in the form of a very low interest loan. And by low interest, I mean low interest. Right now, loan rates for state revolving fund projects are running in the 1%, 2% range. So it's in a loan marketplace. It's kind of tough to beat those. Those loans are then repaid back to the state over time, And the money that is repaid goes right back into that revolving fund and becomes available for a future project for money to be loaned out. So hence the name revolving. The money just keeps revolving. Second source really is the Water Infrastructure Finance and Innovation Act. That came into place in 2014. It actually didn't make its first loan until 2018. But it is a system largely set up to fund bigger projects, $20 million and up. And the Water Infrastructure Finance and Innovation Act, acronymed WIFIA, will loan up to 49% of the value of the project. Again, projects greater than 20 million, also at very low interest rates. Generally not as low as the state revolving funds, but still low and exceptionally market competitive. The WIFIA projects, they also have an annual proposal and review process where they select the projects they're going to fund. This program, Tom, has really caught on. They've issued over 138 loans for greater than $21 billion worth of projects since that first loan in 2018. And every year, more and more entities are applying for these loans because they really see the value in it. Even though it only funds 49%, state revolving funds, cash reserves, municipal bonds, which I'll get into in a minute, can all fund the rest of it. So WIFI has become very popular. And then lastly, on the federal side is the Infrastructure Investment and Jobs Act, which was passed by Congress in November of 2021. It provides a total of $1.2 trillion in funding for various infrastructure sectors, and more than 60 billion of that goes to water wastewater work. A lot of it can be very general water wastewater work. Some of it is earmarked for things like lead service line replacement and PFAS remediation, etc. But the money actually flows from the IIJA into the state revolving funds. So again, the states are actively involved in picking the projects, disseminating the money, et cetera, in a mechanism that has been set up for decades in those revolving funds and works very well. So that's really what we have on the federal side. And then the last one is municipal bonds. And those have been around for a long time. They are essentially a debt instrument set up to fund public sector projects is really what they are. One statistic I saw says that municipal bonds fund about 90% of all public construction that's out there. And of course, that would include transportation and public buildings and things like that. But it's more than 70% of the water and wastewater utilities also use municipal bonds as one of their funding sources. They have somewhat higher interest rates than particularly the state revolving funds or the WIFIA money. But the beauty of the municipal bonds is you can get that interest tax exempt. So it becomes very attractive for investors, even though the interest rates maybe aren't as high as taxable. They still get a nice break on the tax exempt portion, and so they can literally take that to the bank, so to speak. And municipal market has really never had much problem over the years finding investors to buy into these bonds.
Wow, okay. So there are quite a few options available, it would seem.
Mm-hmm.
So where do these funding options currently stand? Like, are they still in effect? Have they experienced any big changes? What can you tell us about that?
A couple of comments on that. One is back to the pay as you go, the revenue from water and sewer rates. The rates are going to continue rising as far as we can see for the near future. There is a general acceptance among the public that the rates are needed, that the systems are in need of work, and they are accepting of them. So right now, a fairly recent evaluation by the American Water Works Association said that only about 20% of the water utilities out there feel they can really fund all of their own capital and operating expenditures from their own funds without ever having to go outside. So that means they're going to have to continue to raise the rates, continue to move towards what we in the business call full cost pricing, which will enable that 20% number to go up higher as more utilities really are able to be in a position where they become self-sufficient in a sense. Our prediction is we're gonna see those continue to rise. On the Infrastructure Investments and Jobs Act front, it will come to an end in November of 2026. Now, some of your readers may have seen that there have been some IIJA funds frozen by the current administration in the White House, et cetera, et cetera. And that is true, but most of that has been in other areas related to energy, climate change, electric vehicles, things like that. The water side has largely remained untouched. And of course, with the kind of schizophrenic behavior in Washington nowadays, there's no guarantee it's going to stay that way. But right now, everybody's got their fingers crossed. It is moving forward like the money's there. It's been appropriated. We can use it, etc. If you have an IIJA project funded, you can continue on that project beyond November of 2026. The work can still go on. The money will all have been allocated by then, though. So if your project is running into 2027 or even later, but you've got the funding, you can still proceed. You don't just have to call a halt to it. We think that the state revolving funds and the Water Infrastructure Finance and Innovation Act will continue to roll along, but those are subject to annual congressional appropriation every year. And a little bit later in our discussion, we'll talk about what's happening in Washington and what some of the latest is on that funding. And then municipal bonds. The municipal bond market set a record in 2024 with over $500 billion of municipal bonds issued. Now that includes all municipal bonds, not just water related. The market seems stable for now. Seems to be productive for now, but with some of the current economic uncertainty, there's some concern going forward. The rates on these bonds have been inching upwards. Haven't had a big leap, but they have been inching upwards. And so we are watching that, and some of that is going to have to depend on some of the fallout from the tariffs and other things, and how the overall economy is affected as to what happens to the interest rates on those bonds.
So, speaking of bonds, let's talk a little more about tax-exempt municipal bonds. So, can you tell us some more about what they are, what they fund, and what Congress is considering when it comes to those bonds?
Well, earlier in our conversation, I gave you just kind of the basic definition. I think probably all of your readers will understand what a bond is. Now, for municipal bonds, there are two types. There are the tax exempt and there are non-tax exempt municipal bonds. Tax exempt ones get the notoriety, get the publicity. They are also more prevalent. They're 60+% of the total bond market. And I'm going to spend most of my time dealing in the tax exempt range instead of over on the taxable side. One thing to always keep in mind on bonds is that the bond ratings will impact the rates. And these come from external rating agencies, Moody's, Fitch, Standard and Poor's, etc. And the higher rating, the better rating that a bond issuing entity has, like a utility or like a city, the more attractive rate it will offer, because it's all, Tom, it's all about a game of risk. And the least risky entities, as far as covering the bond, paying the bond back, et cetera, can charge lower rates. The ones that are more risky have to charge higher ones. It's just simple market dynamics there. There's two types of municipal bonds, both on the tax exempt and taxable side: general obligation and revenue. And the simple difference is that on general obligation, those are set up to be repaid by the general revenue and reserves of the entity itself. A revenue bond is repaid directly by revenue generated from the project or projects it funded. Think of something like a toll road or something like that. So those are the two types. Now we were very concerned coming in the winter, coming into the spring, as the folks in Washington started to look at budget bill and tax cuts and where the money was going to come from to pay for some of the tax cuts, et cetera, et cetera. And one of the things that was tossed into the mix was to eliminate the tax exemption on municipal bonds. It's something that's come up before, occasionally in the past, but pretty much quickly dismissed. Well, this time, because of the sheer volume of tax cuts that were being considered, it hung around a little bit longer than and got some serious consideration, got some scoring done on it. And it was estimated that would generate over a 10-year period an additional between 250 billion and 350 billion dollars in revenue for the federal government. However, as you would imagine, there was massive pushback by local governments and the entire financial industry, saying, you are taking the golden egg away from the goose here. And so in the bill that the big budget bill that the House passed last week and is now over in the Senate, the elimination of tax exemption for municipal bonds is not included in that bill. Now, it doesn't mean that the Senate won't decide, hey, now we really need to improve it. Senate's already made some noise about House, you didn't cut enough. And so, we've either got to make more cuts or we've got to find some offsets. So it's not off the table, but it is, sliding quickly to the edge of the table, about to fall off, and the intense advocacy effort continues to make sure it's not a part of any bill.
Okay, well, I mean, that's encouraging news, at least, that it's toward the edge of the table and hopefully won't be pulled back. But yeah, so if tax exempt municipal bonds were eliminated or curtailed,
Mhm.
what effect could that have on public construction and infrastructure?
It will hurt it. There isn't any question about it. There isn't anybody that will tell you anything any different. If you were to eliminate that tax exemption on municipal bonds, there would still be a municipal bond market out there. Like I said earlier, there are already taxable municipal bonds, but the interest rates will rise dramatically. It was calculated by the Government Finance Officers Association, about on average, interest rates on a municipal bond would jump about 2.1% on average. So what does that mean? It just means that the issuing entity, the city, the utility, whoever, has to pay that additional interest to the investors who buy the bonds. So cost of everything will go up. So projects will cost more in total because of the funding. The local governments, as part of their lobbying campaign, estimated that if the tax exemption were to disappear, that over 10 years, local governments would pay out approximately $824 billion in additional interest payments. And we know city budgets are strapped in a lot of cases already. So where is all that money going to come from? Potentially where it's going to come from is that some projects, and potentially in certain cases, many projects, are just going to get postponed or canceled. they're just not going to get done, and because they are not affordable. And of course, when that happens, infrastructure condition continues to deteriorate. Needed improvements are not made. Certain things have to be taken out of service more frequently, and on you go. So, in a nutshell, Tom, that is the impact right there. Projects are going to cost more, and because of that, you're going to see fewer projects.
So, shifting topics a little bit, can you tell us a little about the Environmental Protection Agency and what we might see in regards to that agency in the future?
Well, there's as all of your readers will know, a considerable amount of change going on in Washington right now, and the EPA in particular is in some difficult and austere times. You might have seen where a couple of weeks ago the White House put out its proposed fiscal 26 budget, and that proposed budget cuts EPA by 55% from its fiscal year 25 levels. In particular, it reduced the state revolving fund appropriations by almost 90%, down to only $305 million for the entire fiscal year, versus the roughly $2.8 billion currently in this fiscal year. What will happen with that? Well, there simply won't be as much surf money to go around. So expect the number of state revolving fund projects to decline in fiscal year 26 and going forward. Now, this is the White House's budget. Congress ultimately funds the government. So Congress will ultimately fund the EPA. However, the House of Representatives has largely tracked along the White House lines and proposed a budget for this fiscal year for EPA that was considerably cut from prior years. The only thing that saved EPA this year is that we couldn't come to a resolution on the budget, so we did one of those famous continuing resolutions that carries last year's fiscal year's budget all the way through this year. So right now we're really operating off fiscal year 24's budget. Now, while the House was doing that, the Senate mostly kept things the same on EPA. They did not make substantial cuts. So right now we're anticipating that that same drama will play out again this year in Congress, where the House will come in, maybe with the administration's budget intact, or they may make some tweaks to it or changes to it, but it will be a noteworthy reduction, and we think the Senate will at least start out trying to hold the line, and we're going to see where it winds up. The one kind of bright spot, if you want to call it that, in there is that everybody seems comfortable with the WIFIA, the Water Infrastructure Finance and Innovation Act funding, staying about the same as on current levels. So that doesn't seem to be a factor. The other thing on the EPA side and related to it is there going to be an Infrastructure Investment and Jobs Act 2? Is there going to be son of IIJA? Whatever you want to call it. There is starting to be talk in the halls of Congress about that. There seems to be general support for something, but nobody I have talked to on the Hill has really come up with an actual plan. One thing I have heard is that a future IIJA would maybe be more, we'll put this in quotes, pure infrastructure, and talk really about what most people think of as infrastructure: energy facilities, transportation, water, etc., and leave out some things that were in there, like the climate change and broadband and EV chargers and do that and really come up with a more straightforward infrastructure bill. That's one thing that's being kicked around. Right now, the White House has been mum on should there be a continuation of IIJA, should there be another bill. They've said nothing of any consequence thus far, so we don't have a real clear read right now on where they are with that.
All right, so stay tuned and we'll see what happens with that.
Exactly.
So then what ramifications could there be for budget and staff cuts at the EPA?
Well, I've mentioned one of them already, and that is if the state revolving fund appropriation really gets cut that deeply, the 90%, you're going to see the fallout from that is going to be just fewer state revolving fund supported projects. That's about as straightforward as you get. Like I said a couple of minutes ago, water wastewater is not seemingly right now directly in any crosshairs of the White House administration. Most of their activity on rewriting regulations or freezing regulations has been in the air pollution, oil and gas, coal, electric vehicles, climate change. Water has largely been left alone, with one exception that I'll get into in a second. You will see an EPA that is not going to be as responsive to environmental disasters as they have been in the past. Thinking of that train disaster in eastern Ohio a while back, you'll see less research being done on the effects of contamination. You'll see less research being done overall on health effects. A number of the EPA research scientists have already left. They're already gone, and they're not being replaced. You'll see a slower rollout on new limits on various chemicals, contaminants, chemical compounds, etc. The pace of that will slow. The one thing on the water side that has come out of EPA that has some consequence is their proposal to essentially rework the polyfluoroalkyl substance or PFAS regulation that came out under the previous administration. And what they've said is that they would only propose to regulate two of the what are referred to as the big six PFAS compounds. That would be PFOA and PFOS. They would be regulated at the 4 parts per trillion, but the other 4 compounds would be rescinded and reconsidered. They've also talked about pushing the compliance date to have treatment in effect back from 2029 to 2031, and by and large, the water industry supports that one because that was going to be a big rush to get everything in place by 2029. And going back to how we started this interview, well, where's the money going to come from? To do all of that when it's been estimated that as many as 6,000 utilities might be forced to put in some form of PFAS removal process. So those, Tom, are the type of changes you're going to see, and in general, just less enforcement and less penalties.
So shifting over to construction labor and immigration, what impact might new immigration policies have on the industry?
Well, could have quite an effect if, depending on how it all plays out. Let's start with this to give everybody just kind of the idea of the overall condition of the construction employment market. Right now, there are more than 200,000 available construction jobs in the United States. That's a pretty doggone big number. And there's a lot of openings out there. And yes, you could categorize it as we have a labor shortage in the construction field. Now, interestingly, if you would have looked at that number approximately a year ago, that number was over 400,000. So, boy, have we made a bunch of hires? Have we, really starting to whittle this down? Not exactly. Here's what's happening. Two things. One is contractors are cautious right now not to overhire. When there were 400,000 jobs out there, if they found a qualified worker, they were going to get them and find a place to put them. Now they are cautious. So when you look at this available jobs, a number of jobs that were sitting there and were still unfilled from that 400,000 just got taken off the want ad list. So, in a booming economy with a clear direction, yeah, those jobs would largely be out there. But right now, with the uncertainty that you alluded to at the top of this discussion, contractors are very, very cautious about overhiring. And the second factor is that other markets, not water and wastewater by any means, but other markets have slowed down and become stagnant. And I'm thinking of things like office buildings, commercial construction, retail construction. They're just not hiring as fast as they used to, if at all. Construction on manufacturing facilities has also slowed down from where it was over the past 2 to 3 years. So those two factors, the caution and just simply saying, no, we're going to take this available position off the website. We're just not comfortable hiring for that. And then the slowdown in the other markets. Now, overall in construction right now, the construction workforce in total, approximately 1/3 are immigrants, and approximately 13% of the entire construction workforce are undocumented immigrants. So any ramping up in deportations could seriously impact construction crews, because we are still shy 200,000 jobs, labor pool availability won't necessarily be able to make replacements quickly and efficiently. So already on sites, just because of the shortages, we have seen examples of schedules being elongated, costs rising because of that schedule elongation, and when costs rise, it generally eats right into the profitability of the project. So those are some of the things that we're seeing out there right now.
And are we seeing any change in material costs due to trade wars and things like that?
We are definitely, and apologies to Madonna, living in a material world. Prices are going up, and we're seeing it fairly steadily, and for many different types of inputs and materials. Since the start of the pandemic, go all the way back to February of 2020, the cost for all construction inputs is up 40% since that time. And, we're only talking about 5 years ago. So that is quite an increase. Now, interestingly, we saw a little blip, maybe some good news in April of this year, when overall construction input prices declined a small amount, about 0.1%, but they at least went down, whereas in prior months they'd just been inching up, inching up, inching up. But a deeper look at the numbers said that virtually all of that was energy. Gas prices were down, unprocessed energy prices were down, crude oil prices were down. Otherwise, things like iron and steel were up 2.3%. Copper wire and cable was up 5%. Steel mill products were up nearly 6%. So it was due to the energy going down, not necessarily any of the actual construction materials that we tend to think of. As you know, there's a 25% tariff on iron and steel in place, as well as a 10% universal tariff on all nations. So, even though we don't have any of the real reciprocal tariff agreements negotiated out and in place. There are still tariffs that are making a difference in prices. We are seeing many suppliers raising prices now. We're seeing domestic producers, even iron and steel producers, raising prices. That was to be expected. It's happened in periods of inflation before. It's happened during prior trade wars before. Even though nothing has really happened to seriously affect the domestic producers, they're saying, "Look, the market is saying the price is here. We're pricing at market," and that was expected all along when these tariffs were first announced. The Institute for Supply Management is projecting that right now raw material prices overall will be up about 7.5% in 2025. So again, we're seeing that number come up. The large insurer Alliance did an interesting study that I was looking at just a few days ago, and they surveyed 4,500 companies in 9 different countries, and just a little over one-fifth or 22% felt that as they understood the tariff situation today, that they could absorb the cost of any increase. Otherwise, 80% essentially said, we're going to have to pass this on to somebody somewhere, or we're going to be out of business. So that gives you a little background on tariffs and what the impact are. And as all your readers are aware, it is the quintessential moving target. Nobody can latch on to anything, and that's what's causing a lot of the angst out there. Is just the whiplash effect, the variability back and forth. We're not settled on anything.
So, yeah, of course, we can't predict what the future might look like, but what advice would you have for people in the industry during these really uncertain times?
Well, it's stating the obvious, but uncertainty is the name of the game right now. Anyone that tells you they know where everything's going, don't buy a thing from them. I think, Tom, some things to keep in mind, particularly about our marketplace. First is that our market, our water wastewater business, has been largely what I'll call recession resistant. It's not recession proof, but it's recession resistant. We are in normal times a slower growing, kind of plodding market that provides good service, good equipment, good everything, but we don't go like this. We kind of just inch up just a little bit, and keep inching up. There's an advantage to being that way, and you can absorb and resist downturns and recessions, and the water industry largely has. Second factor is we are a lagging market. We are a lagging indicator market. Over a number of the past downturns, you can almost set your clock by it. We're about 18 months behind the market. So a recession hits, we just keep on going right along because we do a lot of multi-year projects. And so those keep going, those keep tending. And about 18 months later, we start to feel the effects of it. Well, in that 18 months, a lot of times the economy turns around. And so it almost like it misses us. Even during the downturns of 2008, 2009, 2010, the actual recession happened in 2008. We didn't start to feel it until 10. We were just in negative growth by a handful of percentage points for about a year and a half, and we bounced right back out of it. So we are a lagging indicator, and keep that in mind. And lastly, on the water side, we have the Infrastructure Investments and Jobs Act. And as long as Washington doesn't mess with that, That gets us through 2025, and that gets us through 2026. And again, this year we will, in this fiscal year for sure, we'll continue to have good state revolving fund appropriations coming through. Next year we don't know, but we still have that in our corner. So things to watch for your readers. Watch what happens to the state revolving fund and the WIFIA money in the fiscal year 26 budget. Keep an eye on that. See where Congress is on it and where the money finally lands. Pay attention to some of the chatter that's going to be starting to surface about a continuation of IIJA or IIJA2 in Congress. That's something that we're particularly focused on right now. Obviously, the tariffs, especially on the products that each of your companies imports or exports. Try as best you can to screen out some of the noise and the whiplash about the big picture stuff, but really concentrate. How is it affecting my product? How is it affecting my materials? How is it affecting my bottom line? And then lastly, how are the PFAS regs going to shake out? We probably won't know for sure until sometime roughly about a year from now. But are we going to continue down the path that PFOA and PFOS are going to be 4 parts per trillion, and there's a deadline of 2031, and we still gotta hop to it. I think 2025 is going to be okay for our industry because of all the factors I've just alluded to. 2026, with apologies to those who saw the recent Bob Dylan movie, is a complete unknown. I'm not going to make a prediction about 2026. There's just too many variables in play right now, and variables that keep morphing and keep shape shifting. Too early to tell about 2026. And I guess from just a general overall business sense, think of all things in moderation. It's a good old saying, and I think it really particularly applies here. No need to jump in the bed and pull the covers over your head and hide, and also no need to go on a big spending spree or buying spree right now. Keep moving the company forward, but think of things in moderation.
Wise words. All right. Well, thank you. Thank you so much for such an informative talk. I really think our readers are going to find it extremely useful. So thank you so much.
You are welcome, Tom. A pleasure to be with you.
Huge thanks to Tom for taking the time to speak with us today about funding water and wastewater infrastructure projects. If you're listening to the podcast and would like the chance to watch it, head over to our YouTube page to see the full video version. That's going to do it for this episode. Thank you so much for watching or listening, and we will see you next time.